experience that you won't forget. Hopefully, you guys will enjoy it. Give everybody time to actually join on. We're actually shooting this live, so just going to give everybody a few minutes to actually join in. Good evening, everybody. Those who just joining in, this is Donald Torrance. I'm actually shooting a video about real estate today. I'm going to actually show you some of the deep secrets that banks and other institutions that's investing in real estate, how they're actually doing their investing, and how an average person can actually take advantage of some of these investment opportunities. So hopefully you guys enjoy this today. Um, Sit back and enjoy. But before I start, I actually want to tell everybody about a place on 7149 South State Street. Uh, this this place is the Chicago South Side Marketplace. There's uh, a clothing store that's actually inside. Um, the marketplace. That's really uh, something for you guys to see. It's GQ Gentlemen's. It's, uh, it's ran by a gentleman by the name of Eric. It's a clothing store that you want to check out. It's got great suits, nice ties, nice shirts. It's a place that you just need to stop in and check it out and see what all the fuss is about their store. It's a really nice store. They actually hosted an event for me, so I just wanted to let them know that I appreciate them allowing me the opportunity to come in their store. Um, and it was just really, really nice how they had it set up in the clothing that they have. So, gentlemen, go in there and check it out. This store is not only for men; it's also for women as well. They have purses, earrings, all kind of little things that women will want. So, go by and check it out. You guys will really love it. The next place I want to actually send a shout out is Divine Restoration Construction Company. They're doing some really nice things in the city area with some remodeling of some kitchens and some bathrooms. So you might want to take their number down and give them a call if you're looking for some kitchen updates and some bathrooms or decks. I know it's a little bit cold for a deck right now, but might be something you might want to look at for next year. Get them a call, check them out, see what they have them come out, give you a quote, let them see what you're working with for a project, and you might like them. So I just wanted to put that out. Again, my name is Donald Torrance. I am a real estate investor. I've been investing in real estate for over 21 years, going on 22 years. Started investing back in the 90s, and things had just been great for me as an investor. So, just wanted to bring some knowledge and some of my experience to you guys today, and just basically share what I've been doing and what I've learned over the years, and hopefully it'll help someone else and get them a start on what they want to do as investing. Um, I also host a podcast show. It's called the Real Deal Podcast Show. I actually shoot videos where I'm educating people on how to invest in real estate. I do these because I just want to give back. It's just great to see somebody else come ahead from getting the knowledge. So that's pretty much why I'm doing these, is just to actually get the experience and the not share my experience and get the knowledge out to everyone. Um, I also run a real estate investment company, JAVE Inc. Uh, it's strictly an investment company that buy and sell real estate. I also help people who facing foreclosure, help them to actually stop the foreclosure if they facing foreclosure. It's really an investment company that I started uh, after my mother had passed and my brothers passed. JAVE is the initials from each one of their names. Jesse, Artist, Vernon, Eddie, Joe. Eddie, I'm sorry. We so used to call him Eddie Joe, but his name is Eddie. So I just wanted to give you a little background on me and tell you what my story is and why I'm able to bring you the knowledge that I'm actually bringing you today. So just wanted to get that out of the way and tell you a little bit about me. Um, this is real estate is not a get rich quick scheme. You actually can do a transaction where you can make $100,000 or more, but those are rare deals that you come across. Uh, but you know they are out there, so it's not something to look forward to if it's something you think you're going to get rich. It's a lot of hard work, uh, dedication, and you must put in the time to actually make it successful. Like I said, it's not a get rich quick scheme. You won't get rich overnight, but it is a passive investment. So it is something you can do and get it going and sit back and enjoy the fruits of your labor. So it can be passive. This is real estate is something that can sustain you until your retirement days, even once you retire. It's something that you can continue on to receive income from. I actually want to talk about the cash flow quadrant. It's something Robert Kiyosaki talked about. I think it's important to understand the cash flow quadrant when it comes to business or doing real estate because it's an important aspect of the business world. And I think I took this and put it in here to talk about it because I thought it was very important for you to understand the four quadrants of the business world. He explains it as E, S, B, and I. Uh, the E is for employee, S is for small business, B is for business, and I is for investor. The E is for employee because an employee would always say, "I need to find me a good, stable job that with a good pay and benefits." That's the employee's mindset is to actually find a good job with benefits, something secure. Well, reality is no job is secure. So even though people say they want a good paying job with benefits and security, it really doesn't exist. You see large companies that belly up and close all the time. So they don't. There's no such thing as security. You can stay on a job for 20 years and then one day they come in and tell you you're terminated. Or the company has gone under and now they close. The actual small business, he explains, as the small business owner wants to basically run the business itself. Just say, let's take a grocery store. The the owner is there from 8 o'clock in the morning, depending on what time they open up, until the time that they close. Uh, Sometimes that can be a little stressful on the body if you're working like that 7 days a week. They don't trust anyone. They feel that they can do it all themselves. Uh, they don't want to delegate the work to the employees that they do have, so they want to be there to oversee everything. They want to be in control. Uh, as opposed to the business owner, the B for business, Those are your Fortune 500 companies or individual who hire people to do things for them. They might have the experience, but they prefer to have somebody else do the work for them. Those that allows them to grow to a larger scale and become a larger business. The investor, the iPhone investor, uh, it's because the investor is taking his money that he's made and actually making his money work for him. So he's more so uh, 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 an investor that wants his money to actually do all of the labor for him, and he reap the benefits of what his money is bringing into him. So I thought it was important to talk about this because Robert Kiyosaki talks about the E and the S. They're in a different tax bracket. So they're what he calls poor people, are low to medium income earners, where they're in a different tax bracket. So they're getting taxed totally different than the B's and the I's, the business and the investor. So they're being taxed different. So if they're in a different tax bracket, they're paying less in taxes, which allows them to and grow their money much faster than a regular E or S owner, E employee or S for small business owner because of the tax brackets they're in. So I thought it was important to talk about that. So I want to talk about passive income and versus active income because when you start talking about investing in real estate, you need to think about the two when it comes to how you want to spend the rest of your days because you're investing for your future. So you want to think about that when you as you invest. So passive income is what most of us call mailbox money. It's money that you receive once you set up uh, the actual work that's going to actually constantly keep bringing you money in. So that's mailbox money. Once you create it, you don't have to do anything else. That's your passive. That's passive income. Active income is when you trade your time for dollars. Uh, you're actually going to labor for your dollar. So you go to work, you punch a clock, you're there for 8 hours, and you're working until your supervisor tells you can actually go home. I always ask people this question when they go to work. Do you feel like you have to report into your parents? Do you feel as if you're turned in your time because turned your time back as to being a child again? And the reason I say that is because you have to ask, can you take off? You have to ask, can you? You have to say you're going to be late. You have to basically get permission as if you were talking to your parent. So I use the two uh, as a way to say, do you want to live your life passively or do you want to live your life actively, earning a income as opposed to working, letting your funds or your money work for you to actually give you the freedom that you actually are looking for in life. So I also want to give you a little bit more detail on active and passive income. When you look at active income, you're working 40 hours a week, 26 pay periods in a year. That's 2,080 hours that you spend away from your family. 2,880 hours that you're spending laboring for someone else. At the end of those 26 weeks, or the end of that year, you made $50,000. When you look at it on a monthly scale, that's 160 hours you spent to actually make $3,846.15. Now, that's not counting the taxes that you also have to pay out of that $3,846.15. When you look at the taxes that you're paying, you're actually bringing home 2,000 and some change. So you think about all the hard work you've done. You're paying your taxes, because you're supposed to, even though some people feel that you shouldn't pay taxes. But it's a great thing where you can actually have an easier cash flow. Now let's look at passive income. When you take passive income, let's say you had that same $50,000 that you work and made. If you spend 4 to 6 hours a week for 26 weeks, that's 312 hours that you spend. And that same $50,000 at 15% interest by just taking the $50,000 and investing and earning 15% interest on that $50,000, earn you $7,500 for the year. That's if you don't do anything else with that. You just take it and you put it in some kind of investment, and you make $7,500 for the year. Now let's say uh, six. It took you hours. It took you 4 hours to actually set 6 hours. I'm sorry. Took you 6 hours to set that up. So you spent 24 hours in the whole year to actually get this set up. So you actually made $312.50 an hour for 24 hours that it took you to set up the investment that you was using for the $50,000. So if you can spend 24 hours out of the year and make $312.50 an hour, and it actually makes you $7,500 for the year, wouldn't that be a lot easier to spend this time here as opposed to spending this time here? You have more time with your family, and you have less time with your family under the active investment. So that's why people want to try to set up uh, active or passive investment for themselves, passive income for themselves. Uh, Most people don't know how to or where to actually go, but some people love the idea of investing in real estate. So I'm going to dive into that a little bit more and explain to you how you can have passive income investing in real estate. Uh, Here's some of the investment opportunities that you have today. The stock market. Well, they saying the stock market is doing a little better, but the stock market is always up and down. You never know when it's going to be up or when it's going to be down. Your money market accounts. Right now, the rates, when I put this together to actually do this presentation, the rates right now for a money market account was from 1.11% to 5%. When you get into that 5% bracket, you're at a higher risk of losing your money. So when you start changing the percentage on money markets or mutual funds or CD into that higher bracket of the percentage, you're actually taking a higher risk. Most of the banks will actually tell you that it is a risk that you can lose some of your funding. Uh, Mutual funds. Mutual funds are at 2.38% to 4.47%. This is funny because back in 1997, my mom decided that she wanted to invest some money. So she went into our bank. Most of the time, people tell you to buy CDs. Well, back in 1997, a CD was paying 0.5%. The bank told her that didn't I mean, and I was new into investing in real estate still, so I didn't understand it as well. As time went on, I learned better. I wish I would have knew it then, but my mom went into the bank with $10,000 thinking she was going to buy a CD. So the banker at the time told her that she would actually be better off with a mutual fund. Now, $10,000 in 1997 was a lot of money. $10,000 still today is still a lot of money. So she actually opened up a mutual fund for the $10,000. She, in a year's time, was a 1 year mutual fund that she either can roll over or she can actually take her money out. Well, at the end of that year, she got her statement where it actually showed her how much money she made at the end of that year. She made $100 at the end of that year because the mutual fund paid her 1%. So 1%, and they wanted her to roll it over into another year, so she would have gained another $100 off that $10,000. She wound up looking at it, and it was so funny to me because we were sitting at the bank when she was talking to them about it, and the guy said, "Yeah, that's a good return that you're getting." So at the time, I didn't know to ask, what did you guys use to the money to invest in? Because they had to invest her money in something. The bank don't just take a mutual fund or a CD or a money market account and invest it, and they don't make money off of it. They're making a lot more than you would on that mutual fund that that my mother put the $10,000 in. So I didn't understand that then, but now over time, of course, I have a better understanding of it. So and then your CD rates right now are 1.25. So that's what we have, and your bonds right now are 1% to 1.6. So this is what the banks want you to think, that this is a good investment for you. It's actually a good investment for them. It's not earning you anything. So let's talk about investment opportunities that real estate can provide. Real estate market offers plenty of opportunity to make for anyone to make money. I will show you how going much further than buying a house in today's market, as and using real estate as an investment, as opposed to just thinking of real estate as a rental aspect. I'm gonna show you another form of investing in real estate, so you can actually have multiple ways of investing if you decide to use your investments. And I'm gonna talk a little bit about IRAs, mutual funds, and the stock markets, and other investments that you may have, like 401ks, how you can actually make those, uh, where you can defer your interest on those if you decide that you wanted to invest with those. So you have rental properties. Most people nowadays do buy rentals because of the passive income they can receive from the rental income. Rental income is passive, but there is some work that's involved, and that work might be every month. And when I say work every month, you might have a toilet that broke, or you may have a tenant that got a faucet leaking, or so you're doing work, whether it's you or you're having someone go over and do the work for you. So it's passive because the check comes in your mailbox every month, but you're still doing something for it monthly. And then there's the stress of worrying about if the tenant's going to actually pay you for that month. So then you have the realtors. When the market crashed, those realtors went and became property managers. Property managers. So if a realtor manage your rental property and they really don't have an understanding on what they're doing as a property manager, then you're actually going to be losing money as opposed to making money every month, because a bad property manager can actually cost you a lot of money and make it bad for you to actually have that property. And I meet a lot of landlords that hate their rental property because either they had a property manager that mismanaged their properties and now they want to get rid of the properties. But the problem wasn't the property, the problem wasn't the tenants, the problem was the poor manager who actually managed the property for them, and they just didn't understand that. So, to have a good property manager, you want to make sure you do your due diligence on that manager or that person or company that you decide to use, because that's your investment and your money that you trust in somebody else. So you need to oversee them and make sure that they're doing what they're supposed to. A lot of people have heard of wholesaling. Some people have not heard of wholesaling. Wholesaling is buying a property, $100,000 property for $40,000, and then selling it to another investor for $45,000. So you make that difference of that $5,000 when you go to sell that property. But wholesaling is not passive. Wholesaling is hard work, and you have to dedicate your time, and it's work. But real estate is not something that you can sit back on and not do anything with anyway. But wholesaling can be a good stream of income, but it's a lot of work involved in it. Rehabs and fix and flips. Uh, they're actually good. They can make you a lot of money. Right now, if you watch this quarter, the market for rehabs have increased by 14%. Uh, I watch the trends of how the real estate market is doing, and the renovation and the new construction part of real estate has increased. Uh, they're showing that there is 14% more people jumping into the market doing investing as far as rehabs. So it's on a climb, and the market is going up. So it's if you're thinking about investing, this is now the time that you want to jump in before the market actually hits its highest peak. When people get in, then it's so expensive to get in that they actually don't take advantage of it. The next one that I want to talk about is short sales. I'm certified to do short sales and foreclosures. Short sales are basically when you have a homeowner that's facing foreclosure. They hadn't gone through the foreclosure yet. They put their property up to sale, found out that the property is they owe more on the property than what it's actually worth. So they go to their bank and ask, can they sell it for less than what they owe on the property? The bank has to agree to that and to take less than what's owed on it. Most people don't understand that when you do a short sale, there's two things that the bank can do to you when you do a short sale. They can actually do a deficiency judgment, which meaning that you're signing that you're going to pay them the difference of whatever they sell it as. So if you got $100,000 in property and you sell it alone on the property for $100,000 and you sell that property for $70,000, the bank has the right to say that $30,000 we want you to take out a promissory, sign a promissory note saying that you're going to pay us the $30,000 back. That's one thing that they can do. The other thing that they can do is they can say, okay, we're going to forgive the $30,000, but we're going to 1099 you at the end of the year and say that that was income to you, that we've given you $30,000 for you to file that $30,000 on your taxes. So that's the two options that the bank has at their disposal when they go to uh, do a short sale. A foreclosure is when a property has been foreclosed on and the bank has taken that property back, which is called a REO property, real estate owned. Uh, that's the bank is owned, the owner of the property. They've went through the whole foreclosure proceedings and they actually have title to that property. Investors buy these properties from off. You see them on the HUD list. Most of the time, I don't look at a lot of properties from the HUD list unless it's really a high deal. But most of the time, those properties hit the MLS and it went through Wall Street. All the investors on Wall Street that's looking to buy properties, they look at them first. Then they go to the bank, send them to their pocket investors, see which one of their investors want to actually buy it. The bank does have investors lined up for to buy properties from them. If none of them want them, then they actually give it to a realtor. Well, that realtor also has pocket investors that they send it through first before they actually list that property to see if any of their investors want to actually buy that property before they actually post it on the MLS. Once it hits the MLS, it's not a great deal a lot of times. Sometimes it might be the location of the property. Sometimes the property needs more work than what the bank thought it might have needed. It's a lot of reasons why it wound up going to the MLS and didn't get sold on the market before it hit the what the bank called the top tier investors. Note buying. I really love note buying. Note buyers are, you've seen, if those of you who has a mortgage or took out a mortgage on a property, either at the closing or the next month or sometime during that year time, you might see that you have a new lender. What the bank does is sell properties to the secondary market, which are investors, companies, note buying companies who are actually looking for the passive. This is passive income. They do the work in the beginning to actually get the note, and then once they have the note, what they do is they get a check every month from the actual mortgage holder. So the person who actually is paying the mortgage now is actually paying that note buyer or that note holder. They're paying them every month, whatever that face value payment was every month. They're making that payment to them. It's a really good strategy that some investors take advantage of. I love it. You can actually, if you can actually get notes, you can actually wholesale your notes. So if you get a note that you do not want, you can still wholesale it to another note buyer that wants to hold it. So the last one that I'm gonna talk about, which is I'm going to spend a little bit more time talking about, is lending. Uh, Lending is definitely a passive uh, strategy when it comes to real estate. Uh, Most people love lending because of the passive uh, ability that it has. So there's three forms of lending. Uh, you have your bank, lending source, and you have your hard money lending source, and then you have your private sector of money, lending source money, private money loans. So those are your three sources of lending. Uh, Now, what I want to talk about is the good versus the bad. Which one uh, is better than the other? Which one real estate investors who rehab or who buy properties, which one that they love and why do they love it? The let's talk about the bank loans first. The good side is that you can get into them cheap. There's less money down. The interest rates are low. The terms can be anywhere from 20 to 30 years. So that's the good side of if you're using bank loans. You don't have the high interest rates when it comes to paying back the loans. The bad side of them are uh, you have to have good credit. You can't get the loan if you don't have good credit. You have to qualify, meaning that they're looking at you as the person who's signing for a loan. It's an investment property, so you need 10 to 20% down. Uh, so it stops some people from going to a bank to actually buy an investment property because of how much they need down. And if it's commercial property, say if it's a 5 unit apartment building or more, then you need 25 to 30% down. You have to have check stubs, bank statements, tax returns. They want to pull all your financials to make sure that you actually can afford it. And it gets stressful when you're trying to actually do uh, bank loans. They don't do distressed properties. A lot of investors who are looking to do real estate as an investment, they want to be able to fund stressed properties, and the bank don't. They will not loan on distressed properties. You have to have. You can't have more than four loans at a time. Now, if it's a portfolio lender, meaning that the bank would actually make the loan and they keep that loan within their house, they won't sell it on the secondary market. Once you have a relationship with those lenders or those banks, they may go up to 10 loans. So you're capped out. If it's a portfolio lender, you're capped at 10 loans. If it's a traditional bank, like Chase or Wells Fargo or something like that, then you only can have four loans out. They will not loan after the fourth one. So the hard money loan, the good side of them is they're deal driven. They look at your credit, but it's not totally based on your credit. Um, and the good side about them looking at your credit, and all the reason I'm sorry, the reason they're looking at your credit is to see, just to get a history of who you are and what kind of person you are. The loans are one sided. Basically, if you go to a hard money loan, do a hard money loan, you have to know what you're doing to actually get out of that loan quick, fast, in a hurry. So, because they're gonna make so much money because of the fees that they charge. Uh, they're the ones who's making more of the money. They make more than the investor does. The investor should be making more than the lender, but with hard money loans, a lot of times they make the most. They charge fees for us an additional 6 month extension. If you need to extend your loan past 6 months, they actually charge you a fee for that. The fees for the draws can be extremely expensive. They can charge you for someone coming out to do an inspection to make sure that the house is done, the work is done to the property. Then you have to pay for that person coming out, and you have to pay for the next drawer, which can be expensive. Your private lender, I like to call them private partners, even though most people say private money, private lenders. I like to call them a partner because they are, to me, a partner in the deal, and that's why I like to call them private partners. There is no bad side when it comes to using private money. It's easier to get. Um, they don't look at your credit. They want to look at it, but they really don't care about it. It's deal driven. It's same as hard money. You can get longer terms. You can do 1 year to 5 years, which is actually great if you're doing rental properties. Say if you buy an apartment building and you need to renovate it and show cash flow because you plan on holding it because you want to refinance it and cash the money out. This gives you time to actually do that. So private money is actually going to be a much better source than the other two choices that you have. The fees are a lot less than hard money. The fees are second to none, nothing, if any. Uh, they interest only payments. This is good for the private investor that made the loan, and it's also good for the investor who has the property, the loan on the property. It makes it easier for him as well. And these can be structured in different ways. It's two parties making the decision on how the loan is going to be structured. So long as you're open to the discussion of doing the loan, it actually can be pretty uh, feasible for both parties. What is a private lender? A private lender is basically an individual who has money It's not an institution or they're not a bank. They're making a loan to another individual for the purpose of purchasing and renovating real estate. That's the key to what a private lender is. There's one person that has the money, loaning money to another person who has a deal that he can actually renovate. He's giving him the money to purchase, to renovate, and to do what he needs to do with the property. In exchange, he's getting a note and a deed of trust on that property, showing that he's the lender on that property. There's two type of investors when it comes to private money lenders. Equity investors, they want to either share in the profits or they want to share in the equity. Meaning that if it's an apartment building, they want part of the monthly cash flow. Uh, and they may even want part of the cash flow as well as part of the equity. They can't ask for both. So it just depends on the deal and how you structure the deal if they're able to allow both to actually happen. The debt investor, he doesn't want to share in any equity. He doesn't want any part of the cash flow. He's just looking for the monthly payments. Uh, he's either using his IRA for investing or he transferred his 401k for investing, and he's getting the money tax deferred so he can actually grow his retirement fund a lot faster. So he's using those funds for that purpose. Why private lending? Why would anyone try to actually go into private lending? When you increase the yield on your money, it grows faster. So uh, I showed you in previous screens where mutual funds, stocks, bonds, mutual CDs, where the interest rate was pretty low. Well, if you have a private loan out and you have the interest rate on it at 10%, it's a lot better than you receiving 3% or 2% or 1% on any other investment that you actually do. It's a lower risk. You actually can touch the investment. You don't know when you have a mutual fund or a stock market, you don't know what your money's invested in. You know what your money's invested in when it comes to uh, doing private money loans. It's liquid, meaning that if you had to cash in on the property, you can actually cash in on it if you needed to. It's you don't have to be stressed about wondering where your money's going, what's happening with your money. You can actually see it. You can walk by, touch it, feel it. It's something you can actually lay your hands on as opposed to investing with other entities that you have no idea what your money's invested in. It's no cost to you. As opposed to if you go to a broker and you invest in your money, brokers, you have the broker fees. They're charging you on a monthly basis or yearly basis for them monitoring your money and doing what, making sure the investment comes back to you. And then there's a chance that it may not come back. So those are the difference of it being a hassle-free, no uh, no cost to you for you to actually do a deal, private money loan, and it's tax deferred. Like I said, you can use a retirement account, an IRA, a self-directed IRA. I would advise anybody who's actually thinking about doing this to actually have two ways to invest. One out of your IRA for you to actually build your retirement up, and the other one is to have liquid cash for you to actually build your bank account up. So I would use the two to actually have, so I can have a good retirement and live off of the other. So So you gotta ask yourself, mutual funds and CD are at an all-time low. They hadn't went up much. Just look at from 1997, from when my mom went to get a mutual fund, they were paying 1%. Now the rates start from 2.38%. So they only went up in almost 20 years, 1.38%. That's not what something you can trust your money in. So in the last 2 months, the S&P has dropped 200 points, and the Dow is down 2,000. So it's not too uh, great to invest in those. The stock market is at a very risky rate, even though they say the stocks are doing better. But you got to ask yourself: is this what you trust your money to these days? Is this what you leaving to invest for your retirement? Let's look at the effect of increasing the yield. Just look at a 5-year plan for increasing the yield on your money. If you did 7% for 5 years, that's $4,000 that you can actually increase the $10,000 that you have. Now, if you had a mutual fund or a CD or your money in the stock market, if it's in the stock market, it's a chance that you can actually wind up having $9,000 in a 5-year time. But if you had your money in something that was paying you interest on it, like a safe investment, like a mutual fund or a CD, uh, you wouldn't have that much money. You couldn't have gained $4,000 in 5 years with those investments the way the rates are now. If you took that same, if you had $20,000 to invest, and you can get 15% interest off of that, off of the 15, off the $20,000 that you had, uh, just in 5 years, you would have doubled your money, more than doubled your money within that 5-year time frame. So can you see by increasing the percentage, the yield, when you increase your yield, you increase your cash flow or your return on your investment. This is passive investing. Uh, Most of the people that borrow money borrow. It's going to be homeowners. They may have weak credit. They may have can't prove their income. They may have money that they need fast, and they know that they got equity in their property, and they want to get it out the property. So these are the people who normally borrow money at these rates. There's also investors. I pay high rates on money that I borrow. I'm always looking for money to borrow. I don't need to qualify. The property need to qualify. The property need to meet the investors' guidelines for them to actually loan money on. If it doesn't, then it's not something that I can actually borrow money on. And I don't need the money long term. It's not something that I have to have for years on end. So I'm actually borrowing money probably from 6 months to a year, maybe 5 years. Depends on the property. Let's look at a property with a value of $100,000. ARV stands for after repair value. You take $100,000 property that needs some work. The investor can buy it for $35,000. It needs $20,000 in renovation. He needs a total of $55,000 to actually buy and renovate this property. Not to mention he is going to have some closing cost fees that would actually be factored into that. He borrowed $65,000. This is a safe loan for the investor because if there was a problem with the property, or if there's something went wrong, he could still sell the property and get his money back. It's not like your traditional banks that make loans at 97%. If you're doing FHA, FHA actually changed their guidelines some. So if you actually looking to purchase a property and your credit score is below a certain amount, you need to put 10% down. So it's not the 3% in most cases that FHA has done. But even if you did a loan at 90%, it's a high risk loan. Uh, so many things can go wrong at that rate, and that's why the bank has so many foreclosures because they made loans at high rates to make them not safe. Let's say that he borrows this money, the $65,000. He pays his investors $5,850 from holding the money for the time that he had it. He makes $29,000 on the time he sells it. He makes a little over $29,000 when he sells it. But you have to keep in mind that he borrowed $65,000. He only needed $55,000 for the purchase and renovation. So he actually made $39,000 off the property when he sold it. So this was a good opportunity for this investor to buy and renovate this property. Now you can see why he would have wanted to actually. He didn't care about the interest rate. He didn't have a problem with paying a high interest rate to this investor because the amount of money that he's made. Let's look at this deal from another standpoint. He takes him 3 months to buy the property, renovate it, same $100,000 property. Takes him 3 months to actually buy it, renovate it, and get it sold. He borrows the $65,000. He's making payments of $975 for the time that he has it at 15% interest. That's what the payments would be. He worked out with the private lender 3 month prepay. So he's paying basically 6 months of payments for him to have that money for 3 months. So he's paying $975 plus he's paying 3 months prepay, which is 2,900, and then he's doing 3 months of payment of $2,900. So the investor makes the $5,850 for the 3 months that he had his money out. That's a pretty good return to receive in 3 months uh, for him loaning his money out. That it was secured with a piece of real estate. That if he needed to, he could have made the money that the investor made. He gets a check back upon the sale of the property before anybody else get paid. He has to get his check at the time of closing. So the title company would take his $70,850. If it was a retirement account, that $70,850 will actually go back into the retirement account. If it was just his personal savings account or checking account, wherever he had the money in, it would actually go back a wire transfer to wherever he told them to actually wire the funds to. So you see why most people want to dive into the private lending sector because of the kind of money they can make off loaning their money for a few months. Where's where's the money invested in? Most people ask that question when they're making private money loans. They want to know because they're new to it and they want to know where it's invested. Uh, Mostly the investment that the investors that I know are doing now are in the Illinois and Northwest Indiana, where they're revitalizing the neighborhoods for local entrepreneurs to perform the needs for neighborhoods. So uh, they're actually doing pretty good with with that now because, like I said, it's up 14% this quarter. You can provide affordable housing for first-time home buyers or displaced families. This gives them an opportunity if it's a rental property. If an investor is doing the property for a rental, he can actually give displaced families who've been in house, may have been in a fire, and they need to relocate to another apartment. It gives them the opportunity to provide them with housing. Or first time home buyers, it gives them a nice property to actually look at to actually purchase. And it stabilized property values across the metropolitan area by fixing up distressed properties. This actually stabilized the value of the properties in the area. And here's one of some of the main reasons why I love private lending. The investor performs due diligence on the property to make sure it meets the investor's his financial stability. It's what he wants. It's the type of property he wants to loan his money on. So he's comfortable with it because he's already see what he's actually going to be investing in. Other investments you don't get a chance to pick and choose. You don't see what your money is invested in. You're just flying by the seat of somebody else's pants and letting them choose your investments for you. The loans are based on the value of the property, of the after repair value of the property. That's how the loans are based. Uh, this concept is much more stringent than traditional hard money lenders, and it's are asset based lenders, meaning that you get to control that investment. A lot of times, those other investment are hard money lenders. They can make that choice, but as uh, private lender, you can actually go out and physically see the property if you decided that that was something you wanted to do. You always need to follow the loan guidelines. Never make a loan more than 70% of the appraised value after repair appraised value. You always want two appraisals. When you do a when you're going to do a loan on a property, you want to see the as is value and the after repair value so you can know what the improvements that's going to be done to the property, what it can actually increase to. You can earn up to 15% interest, 6 months with an extension, or you could do it 1 year with an extension. It's up to you. You make that choice. They fund, private money lenders fund 100% of the purchase price, the closing cost, and the cost of the repairs that needs to bring the property up to its current value, its potential value. These guidelines is something that every private lender should do upon their first loan with an individual. It's to give you an understanding of who that person is. Private lending, I say private partners because it's a relationship. You're building a relationship with that person and you want to get to know them as intimately as you possibly can. It's as if you're going on your first date. You want to ask as many questions as you possibly can to the young lady that you're dating or guy that you're going out with. You want to get that same relationship that from the investor who's coming to you with the deal that's looking for the funding. Uh, so you want them to fill out a 1003. A 1003 basically tells you what kind of assets they have, what kind of liabilities they have. It tells you their basically their history of themselves. It tells you about how many children they have, if they married. It gives you all the just of their life to tell their story. You want to look at their tax returns if they have. Uh, it's not it's not something that a deal breaker, but you want to know what has this person been doing for the last 2 years. If they've just been strictly investing in real estate, they still should have a tax return. If they have been a W-2 employee, you want pay stubs. You want see their W-2s. Their W-2s should be reflected on their tax returns. You also want bank statements. You want to see what kind of funds they have available in their account. Again, none of these are deal breakers unless you are these are deal breakers for you. This is all to the individual. The individual can make that determining factor. You want to look at their credit. Not that it's again, it's not going to be the determining factor. And you definitely want to see a repair budget. You want to see that they actually know what they're doing when it comes to renovating this property. Uh, is the boiler or the furnace something that they're looking to update because it's the original one from the house being built in 1905. You want to see that they're actually paying attention to the details of the property so that you know that they know what they're doing to actually get this property sold. The downside, there's a downside in anything that you do. Uh, to tell you all this and tell you that it's peaches and cream, it's not. There is some downsides, but those downsides, if you're working with a good investor, he's supposed to be a problem solver for you. What if the house don't sell? That investor need to know what to do with that property. He should be telling you, okay, I plan on selling the property. If it don't sell, here's a plan A or a plan B or a plan C in some cases. He need to be able to tell you what his plans is if the property don't sell. Uh, what if they stop making the payments? What's going to be in place if he stop making the payments? What if he uh, wound up getting hit by a bus and he's killed? You need to have plans in place for if he stop making payments. If something happens to him where it makes him unable to make those payments, you need to make sure that there's something in place for that purpose. What if the property get destroyed? What if he destroys the property because he's mad because he just fixed it up and the property didn't sell, and now he's stuck with a property that he can't do anything with? You need to know if those things happen. What are your recourses from? You need to these are questions you need to make sure you have answers to, and that's the reason I'm putting this together because now I'm getting a lot of people who want to actually get into the private lending sector with real estate because they don't either have the time to actually go out, find properties, fix it up, manage contractors, manage the sale of the property. It's a lot of work when it comes to selling a property, and some people just don't have that time. So what they prefer to do is they have money. They prefer to put their money out and have their money work for them. So, and that's really the whole purpose of me putting this together is uh, to make sure you're aware of what you need to be doing to make sure that you're safe when you're actually making these kind of investments. Who maintains the property? Does he have a security service coming by and maintaining the property? Is somebody cutting the grass? Who's doing the upkeep on the outside of the property so the property won't accumulate any tickets from the city enforcement? So these are questions you want to make sure that they're able to solve problems when they come up uh, for any deal that may go bad. So you want to make sure that that person can articulate uh, issues that may arise. Uh, our role, I say our role, what is our role? But I normally, when I work with an individual who I'm actually borrowing money from, or I send somebody their way to actually borrow money, to be a problem solver for them. I want to make sure that if something arises that they're not aware of, that I can solve that problem for them. Protect the lender at all costs. Make sure that their money is safely returned. Most investors, most private money lenders really don't care about the return on their money. They are more so concerned about the return of their money. So they they will loan their money out, but they want to make sure that their money is coming back to them. So They're more so concerned about the return of their money as to opposed to the return of the return on their money, which is important to them too. But they want to make sure that that is coming back to that their money is coming back to. You want to find good deals. I mean, I will not bring a deal to one of my private lenders if it's not a good deal, if it's not a win-win for them or me. It's a waste of their time and mine. So I want to make sure that they have a good deal in place when we actually they see a deal that's been brought to them. You got to have a niche when you're dealing with real estate as far as finding properties. You have to be able to consistently find distressed properties, properties below market value, for you to actually be able to buy them at a decent price, to be able to have the crew in place to actually do the renovation to those properties. So when you find those properties, you need to make sure that they're properties that meet those criteria, where they're distressed, whether it's foreclosures, undervalued, distress, whatever the case may be with those properties. You want to make sure that they're able to be improved by fixing them up to actually put them back on the market to sell them. And your closing package, you should never do a loan on a property without making sure that you get title insurance. This assures that there's no liens on the property from the title company, and the title company is guaranteeing that that property is free from any liens or anything of that nature, so you can actually get a free and clear property. The original note. You should get the original note, not a copy note, but it should be blue signature for you to actually know that it's an original note. You should get original notes when you do a loan. Hazard insurance. You want to make sure you're named on the insurance in case the property catch fire. There was a property that I was involved with a few months ago. Somebody stole the car and parked it in the back of the house, and the house caught on fire because they set the car on fire, and some spark from the car landed on the roof of the house and set the house on fire. uh, the uh, the investor was able to receive the money from it because the insurance kicked in and paid off the property. Actually, it was actually a pretty good deal that they called a fire because they paid more than what the property value was on the home. So what the loan was, or what we was planning on putting the house on the market for, the the check that we received was a lot more than what we had initially planned on selling it for. So you want to make sure you list it as an insured on the insurance. Assignments. Rent assignments. Let's say it's an apartment building, 10-unit apartment building that's being renovated. The person stopped paying, or the person something happened to him, put him in the hospital. He can't finish the renovation on the property. When you get access to that property, you want to make sure that you're able to collect the monthly rents on it. You don't want the tenants to not know where they're supposed to be sending their rent checks to. So you want to make sure that you have a rent assignment there if it's an apartment building. Promissory note. It's good to have a promissory note because uh, if you needed to, if you wanted to go after the individual, you can go after them because you have a promissory note if something happened. The appraisal, like I said earlier, you want to make sure that appraisal show you the as-is value as well as the after repair value of that property. You want to make sure that that property is it's telling you all what it is, so you can know what the value of this property is. Termite reports. Termite reports are if it's a tree around the house or it's a frame house, then yes, I would say get a termite report. But what's important is a property inspection. I would always ask for a property inspection on every property because there you want to know the unforeseen, and it helps the investor know what he needs to be doing to the property also when he's doing his renovation. So you should always get a uh, an inspection report as opposed to a termite. The inspection report will tell you if they find termites and it needs a termite inspector there anyway. So I will go with that, the inspection report, and then if they know, say in the report that a termite report needs to be done, then I would do it at that time. This is basically the breakdown of private lending and the whole ramification that's involved with private lending. I hope this helped you guys out. Hopefully, you guys got a good understanding of it. And I just want to make sure you understand this to the fullest. When you do the loan, you want to make sure that you're in first lien position. You have the first mortgage on it. There's nobody, there's no other bank or anything on this property besides you. It can be a second, but you want to make sure you're first. It may be the owner selling the property for $100,000. Uh, the property's worth $100,000. The owner's willing to sell it for $40,000, but he wants $20,000, and he's going to hold a second for the other $20,000. You want to make sure that the owner's is in subordinates his loan where he's not in first position, where he's going in second position. Because the person in first position is the winner, and that's why banks always want to make sure they're in first position. So you want to make sure you're in first position as well. So for those who are interested in investing in real estate, becoming a private lender, you should always expect an 8 to 15% return. It depends, the 8 to 15% range, it depends on the property. Every property is totally different. There's no way, if you're doing a $1 million property, that a investor can actually give you 15%. It actually sometimes drop down a little lower than the 8%. You might wind up with 5 or 6%, but it's on a larger amount of money. So the return on your money is still great. Um, you want to make sure that you get a trust deed to make sure that the property you're secure with the property. You want to make sure that you're holding a good, valuable piece of real estate. You want to receive monthly disbursements. You want to make sure that you're getting checks on a on a monthly basis, and that it's spelled out in the mortgage what that payment would be. You should be communicating. Your investor, whoever borrowed the money from you, should communicate with you on a regular basis. So, uh, those who actually stayed, if you actually uh, would like to receive a copy, I have two ebooks out. Um, How to Sell Your House Fast in Today's Market and Knowing Your Rights While Facing Foreclosure. I did these books primarily to help homeowners because I've talked to a lot of homeowners over the years that I've been investing, and a lot of times they struggle with trying to sell their properties. Either A, they owe more than what the property is worth, or B, the house is in disrepair and they can't sell them. So I put this book together to try to help some homeowners out who may want the book, uh, need some help. I also did the book on foreclosure because a lot of people just did not know what their rights were with facing foreclosure. So I did these just they free. If you if you go on my website, www.javeinc.com. Again, that's www.javeinc.com. And go to the book tab and click on it. I'll actually get these books out to you free of charge. You can actually email me at Donald Torrance, my name, Donald Torrance, 1 at gmail.com. And I can actually and just tell me which book you want, or if you want both of them, I would actually email you both of them. Um, Again, they free. It's not a charge for them. It's to help individual out. I hope this information was helpful to you, and you guys like the information that I provided to you. Also, don't forget to stop by the marketplace, and for those who are looking for some suits or some shirts and ties, uh, don't forget to at least pay them a visit. Just mention my name when you go in there and talk to Eric. Let him know that you heard about him via Donald Torrance or a YouTube video that was done, and you just wanted to see what it was like. And also, if you wrote down the number to the Divine Renovation Construction Company, uh, give them a call and have them come out and give you a free estimate. See what they can actually do for you. This has been great. I really enjoyed this. Hopefully you guys did as well. I know I got to do another follow up for the because I've been doing this series for those new investors who are actually getting out here starting to invest. The next stage is marketing. I'm going to do a marketing piece where I'm actually breaking down uh, where to find deals for them. So thank you. Appreciate your time and look forward to doing many more of these. Like this, share it, follow me, so you can actually stay in touch with more videos. Thank you again.